If you're wondering if you should buy down your interest rate, what it means, what it's gonna do to your monthly payment, how much it's gonna cost, and if it's even a good decision, I'm gonna break all that down in this video. So what does it mean to buy down your rate or pay points? Those mean the exact same thing, but essentially you can pay money up front to get a lower interest rate. When you're buying down your interest rate, there's a lot of different options. The further you buy your interest rate down, the more expensive it gets. So if you're quoted, say, 7% interest, and the next step down is 6.875, you could buy down to 6.5, you could buy down to 6.25, 6%, it can keep going, but it does get more expensive the further you buy your rate down. When a lender quotes you an interest rate, they're quoting the natural rate or whatever your qualifying interest rate is. Some lenders will call this the par rate. A par rate just means that you're not paying to get the interest rate and the lender's not paying you to take that interest rate. So outside of your qualifying rate, you can go one of two directions. Your rate can go down or it can go up. You can pay money to get a lower interest rate, or you can get a lender credit or get paid money to take a higher interest rate. When you're paying to get a lower interest rate, think about it like prepaying some of your interest up front so you have a lower interest rate throughout the remainder of the loan. So why would anybody want to buy their interest rate down? Well, there's a few reasons. Number one is pretty obvious. You can get a lower monthly payment. So if monthly payment is super important to you and interest rate is keeping your payment higher, you can actually pay to get your interest rate lower, lowering your monthly payment, making the house a little bit more affordable. Another reason why you might buy your interest rate down is to qualify for a higher price range. So when lenders are determining how much you can borrow, they're going to look at your debt to income ratio, and your monthly payment is included in that debt to income ratio. Well, if you can buy your interest rate down, get your monthly payment lower, allowing you to buy a more expensive house. But there is a flip side. So buying your interest rate down, obviously it can get very expensive. The further you buy it down, the more expensive things can get, and you might not have the money available to buy down the interest rate. Plus, if you're not going to keep the house for a long time or you refinance in a short period of time, you might not recoup the money that you paid to buy your interest rate down. But let's break all this down. Let's talk about the different things that you need to look out for and be aware of if you are going to buy your interest rate down. The first thing I look at is what else can we do with the money? Let's say you have 10 grand to buy your interest rate down. If you paid all that towards buying your interest rate down, obviously it's going to lower your monthly payment. But can we do anything else with that 10 grand? Let's pretend that you have a credit card that has 10 grand on your credit card with a $250 monthly payment and 22% interest. Likely that's going to get you a better rate of return than buying your interest rate down. So I would probably pay off the credit card as opposed to buying your interest rate down. Number two is, do you even have the money available? Is it going to put you in a bad financial position to pay that money to buy the interest rate down? So if after down payment, your closing costs, you're left over with 5 grand and that's all that you have to your name, and you want to use all that 5 grand to buy your interest rate down, I probably wouldn't do that. It's not a great decision. I would leave that money aside for all the stuff in life that can happen. Next is, how much is it really going to change your monthly payment? Is it going to save you $100 a month? Is it going to save you $50 a month? And deciding if it's worth it to trade however much it's going to cost up front for that monthly payment savings. The single most important thing when it comes to buying your interest rate down is the break-even point. This is something I talk about with every one of my clients and make sure they fully understand and that we're going through the numbers, because your break-even point is the only number that matters when it comes to buying your interest rate down. So to figure out your break-even point, what we can do is take the cost, the upfront cost of buying your interest rate down. Let's pretend it's $10,000. And then we can take our monthly payment savings. So if it's going to save you $100 a month, we can divide the two. Divide the $10,000 upfront cost by the $100 a month in savings. And that's going to give us how many months it's going to take to break even on that $10,000 cost. So in this example, it's going to take 100 months just to break even. Why it's so important is, let's pretend interest rates come down in the next 24 or 36 months and you want to refinance to a lower interest rate. You can, that's completely fine, but you just wasted a whole bunch of money on your interest rate buy down. All right, I know that's kind of confusing to think about, but an easier way to think about it is, let's say that you took that same $10,000 and you just put it in a savings account, just a separate savings account. And every time that you go to make your monthly payment, you take that $100 a month out of that savings account to reimburse yourself. Well, you'll be able to withdraw 100 times out of that account, withdrawing that $100 every single time to reimburse yourself. So it's going to take 100 months to deplete that savings account. So let's say it's 36 months later, interest rates come down and you decide to refinance to a lower interest rate. It makes sense, you decide to do it. Well, you would have been better off by just putting that 10 grand into a savings account rather than paying it all to buy down your interest rate. But keep in mind, that's only because the break-even point was 100 months away and you refinanced before that point. But in a normal circumstance, that's a very extreme example. In a normal situation, what we see is a break-even point anywhere around like 24 months, maybe 30 months. And that's a more reasonable number. I generally look for a break-even point on any sort of buy down to be under 30 months, because we can look at the economics and look at all the people much smarter than I am predicting where interest rates will be at. And for the most part, the consensus is they're going to be at this level for the next, 18 or 20 24 months. But if the break-even point is say 12 months, then fantastic. That could be a really good decision as long as you don't sell the house in 12 months or you don't refinance before 12 months. Anything after 12 months, you're gonna be making money from the interest rate buy down. Or I guess a better way to put it is you're gonna be saving money from the interest rate buy down. When it comes to paying for an interest rate buy down, this is something that the seller can pay for. So you can negotiate this whenever you're making an offer on a house. Let's say you negotiate for $5,000 in a seller credit. We can use that $5,000 seller credit to actually pay for your interest rate buy down. So should you buy down your interest rate? It all depends on that break even. This is the strategy that I'm recommending to all my clients right now. Let's say that you found a house for $300,000 and you and your realtor decide that you're gonna offer $295, or you can get it for $295. Instead of offering $295, I would still offer the $300,000 that they're asking, but ask for that $5,000 difference in the form of a seller credit. So you're offering $300,000, asking for a $5,000 seller credit. It's the same number to the seller either way. Whether you offer them $295 or you offer them $300 with a $5,000 credit, the seller still walks away with $295 in both of those examples. But with that $5,000, we can use it towards buying down your interest rate. We can use it to reduce closing costs. We could use it to, lower the purchase price if we wanted to, but it gives you more flexibility and you can have the seller pay for that interest rate buy down. And that's gonna save you more money over the long run than buying it for $295. So if you should buy down your interest rate really is gonna depend on the break-even point. Is it under that 30 months, give or take, and can you get the seller to pay for it? Or are you in a good financial position where you don't necessarily need that money? If all those are yes, then it could be a good decision. It could save you money over the long term. You just need to make sure you're working with somebody who understands all these different factors and can help you lay all this out so you're not making a bad decision or spending money on something that doesn't make sense. So if this was helpful, please like the video, share it with somebody else who might need to hear it. If you have any questions, drop them in the comments or feel free to reach out to myself or my team directly.